Hello and welcome to October's edition of SFI Not So Live with me, Jay Evans, your host. As always, stellar panel to discuss issues in the news and facing the mortgage and property industries, as we always do, with a little steer at the start of this one on something that I'm very passionate about, so I'm looking forward to this one indeed. So let's do a quick introduction to the panel as they stand at the moment. We do have someone joining us a bit later. So Tony Hall, good morning. How are you? Introduce yourself, please.
Yes, thanks, Jay. Morning, everybody. My name's Tony Hall. I am the head of business development at Saffron. My role is really ensuring that our broker and distribution partners get everything they want and need.
There we go. And our special guest for this month, for good reason, which we'll come to in a minute, is Jonathan Southgate. You get that right in a minute. Morning, Jonathan. Just a little introduction for the audience, please.
Hi, Jay. Thanks a lot for having me today. So my name's Jonathan Southgate. I'm the founder and advice lead at Sterling Southgate Mortgages, based in Monmouthshire. So yeah, we're covering Monmouth, southwest England and across the south of England.
I'd just like to introduce here that Jonathan's with us for a variety of reasons. He's very knowledgeable about the industry, but also he has a special extracurricular activity, let's call it that, regarding mental health, which we'll come into in just a second. But just a little caveat from me. We are a podcast where we give our own opinions, not necessarily that of our companies or employers. So sometimes we might steer slightly off topic. And if we talk about rates and other things, it may be slightly out of date depending on when you're listening to us. So this is being recorded on the 29th of September 2023. So that's the boring bit out of the way. Now we get onto the topics. So we will be picking apart some of the news agenda that's happened over the last couple of weeks and some of the things that we found interesting or we want to talk about. But the first topic is something slightly a curveball, which we like to do on this podcast anyway. And we want to address mental health in our industry, looking at both the lender side and the broker side, which is why Jonathan's with us. So Jonathan, you are a member of the steering group for the Mental Health Charter. Now, I think majority of the audience will have heard of it, but as you know, we do pick up audiences around the world. So maybe can you just give us a little introduction into the Mental Health Charter, just so people know what we're going to talk about?
Yeah, absolutely. I think that the Mortgage Industry Mental Health Charter was founded by 7 founding members from the industry around about 12 to 18 months ago now. And it's designed to educate employers and teams on what good mental health looks like, and try and create a framework for businesses to kind of work towards ensuring their teams are well looked after. I think the medium-term plan is to create a safe space with lots of tools and resources for people to pick up on, and whether that is an employee who's looking for support, or a team leader or a business owner who's looking to create that framework for their teams. So we were early signatories. So we're not founding members, but we are early signatories to the charter, because it really struck a chord with me. So my own personal experience of mental health has been, we've had very good days. I've had very, very bad days, and some very dark days indeed, working for 20 years in property and finance. So when this came across the desk and I saw the opportunity to join the steering group, it made absolute sense to try and just add my piece and my little story into this to try and guide and support the direction of the Mortgage Industry Mental Health Charter.
Just a quick question for you from me to you. Did you find your mental health suffered a bit more once you started your own business? You said you've been sort of 20 years, but did you find that the particular stresses of having a business and everything that goes with that put a slight more pressure on your mental health?
So it's interesting, actually. So I've had a few episodes in my life of poor mental health. So across that time, there's been different triggers. But the most recent trigger was, believe it or not, the pandemic. Going from a face-to-face business, working for another business with, a lot of collaboration, an office-based environment, to being thrust from home, not knowing really what was going to happen with the mortgage industry. And, the doors were closed for a few months, and there was a lot of panic. You've got 30, 40, 50 clients that you are managing, and they're all pulling you in different directions with their own fears and concerns. So it was unprecedented, and that definitely impacted my mental health during that period. But it was actually the final thing I needed to be able to set up on my own, to go through that, to realize the resilience, and then to come out the other side of it and set up a pandemic business, as they're now being cast, was either brave or stupid. But I'm sticking with brave for this podcast.
And I would stand by that with you. I did exactly the same. I was slightly post-pandemic, but I went out on my own shortly after the pandemic because I thought, actually, this has changed my perception of what I want for my work life. Just for the benefit of the podcast, I do campaign for mental health. So this is going to be a topic that I will perhaps bring some of my personal stuff into as well. But Tony, just quickly, actually, I'll stick with Jonathan just for a second. The steering group, what's the purpose of your steering group? So what influence will you have on the industry, and how will it evolve mental health awareness across the sector?
So we're boots on the ground, right? So we're advisors, business owners, and lenders and providers as well. So it's a good cross section of people that have got a real interest in making a change in our industry. So the steering group's predominant exercise is to just have a bit of blue sky thinking about, what ideas, what other industries are doing perhaps that could impact our industry, but also to try and just make sure that, the founding members of Mortgage Industry Mental Health Charter, or MIMHC as it's being called, have a resource that's direct and a good collaboration to try and draw ideas through. The first meeting was yesterday, and it was a welcome, introduction, backstory, and you'd be surprised how quick those ideas started coming out. Mm-hmm. And I'm pleased that a few of those ideas will be taken forward, and they've got a meeting. The predominant group have got a meeting next week to kind of just discuss those initial ideas. So I feel like it's an opportunity for change.
It's nice to see. I've seen across my work and working with one of my clients who's in the mental health arena, I've seen lots of industries stepping up to the mark, and it's really nice to see such a cross section. As you said, it's not just the lenders or brokers, it's everyone together, and I think that's really important that we pull together. Tony, let's just have a quick chat about Saffron, because that's where you work now. But you must have seen, you joined during the pandemic, really, didn't you? You come in at the worst possible time in some respects. But what's your view on what Saffron have done? Have you guys seen issues within your teams? And also, let's just talk about you've got a kind of hybrid model working as well. So how's that been to manage with people too?
Yeah, well, I think that. Well, firstly, let's talk about Saffron. I think, and I was. I had my own mental health challenges at joining Saffron. I'd been through a bit of a rough period of redundancy, and then furlough, and then redundancy. And so Saffron was my step back in. And what I was really delighted about with the society is its focus on the well-being of its staff, hugely, and it isn't just, I know we're talking about mental health, but it's about well-being in general, which I suppose is all linked to mental health. But we have engaging talks. We bring people in on our Wednesday sessions when the whole society can listen in, and which works really well. But from a mental health perspective, I've worked for 12 banks and building societies throughout my career, and Saffron is definitely the most progressive in terms of the well-being of its staff. Okay, and I think that is before the pandemic, and it's only amplified during the pandemic and post-pandemic. We have, I think it's up to 6 or 8 mental health first aiders now across the business. So that's the first point of call if someone wants just to chat. We have an extensive network of counselling opportunities provided by the society to support, and I've had certain members of my staff utilise that over periods. So as a business, it's really up there for us. That's why when I saw this the other day, I was like, we need to get involved in this, because we can really help, because we've done some of the learning, we've been through this, we've made some of those. I'd love to know the ideas that Jonathan was talking about, because maybe we've done them as a business and can provide some feedback. So that is the key. I mean, going back to the question around hybrid working, none of my team, 14 of us, work in head office. We're all remote, okay, which works for us, okay. That's even my telephony teams. We're set up as an organisation to work from home. But we do now have people kind of getting into this routine going, actually, I need that fix of humanity. And they go into the office once a week. And as a business, that is a challenge for us because we have more staff now than our head office can manage. So it's how do we create that flexible working environment that we've got, which the business is doing very well with. But my team speak religiously every day, virtually, but they have a morning meet and then we have an end of day meet where we all just get up, and it is business focused, but it's just about life. It's just about chatting and realizing that we're all in it together. Yeah, which really works, and it is completely voluntary, but everybody attends. I love it. It's great. We just have 15 minutes. Sometimes it goes over, but that really helps. And then the only stipulation I have is that we all meet once a month minimum in our head office as a team to energize and just go through what's going on. So that's kind of how we have made hybrid working, it worked for us really. Mm-hmm. And it does work. My productivity has never been better.
Yep. And I think you just said something there that's pretty important to define is mental well-being and mental health, because you've got mental health illnesses and you've got poor mental health, which are two very different things. Those that are suffering from PTSD or anxiety that's clinical, then you've got the what we could be seen as the mental well-being. So people who are suffering with stress, anxieties caused by work or caused by personal life. So I think it's so difficult to get the language right sometimes to understand the variations and the differences. And I think it's so important that companies like Saffron and are so good to hear support that and have that network in place. Jonathan, as part of this steering group and as part of part of MIMHC, let's call it that, have they done the research and tried to identify what the industry looks like? I mean, I know from talking to some brokers what their working patterns are like, and I know from Tony's perspective, it doesn't matter how effective the business is at looking at the well-being of staff. Sometimes the work pressures are tough, and things are tough, and if there's things they need to achieve. So, what's gone into the initial stages of this?
So I think it's really important to kind of highlight at this stage, there are multiple different ways that advisors work in this industry. We've got employed people, self-employed people. We've then got one-man bands. We've got people who've got 3 or 4 team members, some with admin, some without admin. So there's no one size fits all for this industry. So I think the predominant focus is to try and reach out to some of the networks, get them involved. So that's quite important because they've got a lot of one-man bands through there. So that'd be a great way to kind of, really reach into the home, so to speak, and help people. But to answer your question, I think, there's so many facets to mental health and to well-being, as you say. It's just chunking away bit by bit. So creating the resources, creating that safe space, and then allowing a lot more feedback from the industry, because different people are going to need different things. If you speak to a large brokerage with 100, 200 staff, they're going to have a very different view on what good mental health and what culture looks like in their industry and in their business. Whereas if you speak to, Mr. Jones down the road with his mortgage practice, what does that mean to him? Is he working from his home office? Is he trying to work around family? What pressures is he feeling as maybe the sole breadwinner or one of the main breadwinners? I mean, it's a very, very different thing across the piece. So to try and hit the mark with every single individual in our industry is tricky.
Of course.
But I think it's a collective effort. That's what it needs. It needs everyone to be talking about it. And we talk as we've all had stories of this where we hear of something bad happening, someone taking their own life, and saying, "I wish you'd just spoken to them." And those kind of conversations aren't happening.
It's the stigma, though, as well, isn't it? We're a male-dominated industry in the broker industry. There's a lot of males in there, and it is a stigma. It's still got a stigma attached to it, which is incredible when we've been through the pandemic and it's been so vocally talked about. Yet there's still a stigma where people are like, "I'm not going to put my hand up and admit it. I'm too scared."
You've got millennia of dogma, mate, where blokes don't talk about stuff. So it's a very hard thing. It'll change in the next millennia, but it's going to take a while.
It's unpicking so much, isn't there? I think that's the thing. And we've got to start somewhere. And this is what this is all about. It's about creating a base point, for other companies, other individuals to really take it on. This will no doubt evolve over the years into something completely different. But it's a start in that conversation, and we always talk about talking, don't we? But this is the conversation starter. So when we're talking to networks and individuals and lenders, I think it's great that Saffron want to be involved in this. I look down the signatories of this charter, and there aren't enough lenders there. There aren't, and it's my concern only is that we don't want this to be a tick box exercise. Oh, look what we've done. It needs to be, this is...
It has that danger, doesn't it? It has that danger of everyone going, oh, yeah, I've done that. That's done now.
Yeah. And this is not what it's about. It's about how can we affect real change and just kind of look out for people a bit more. That's the big thing.
I think that's a nice way to end that, actually. Look after people a bit more. I think we'll leave that there. But Jonathan, thank you for joining us on the podcast. But actually, thank you for that, because I think we were very keen, weren't we, Tony, to make sure that we added our voice to this and put it on this podcast and spread the word a bit more. So anyone from networks that is listening to this, I will tag Jonathan in any LinkedIn post if you're following me. If not, search for Jonathan Southgate yourself. Maybe get in touch with him or anyone in the steering group, and let's get the industry talking and let's get pushing, because I think this is vitally important.
Absolutely.
Yeah, and we can help, because obviously I've got relationships with all those networks. So when I next speak to them, I will be mentioning this, so we can help spread that word as well.
Great stuff.
We will tagging away on LinkedIn and everything, and I'll put loads of links at the bottom of the podcast. So wherever you're listening, have a scroll down, have a look, and there'll be some links on there and people to follow and find. So that was a nice way to start the podcast. I do like a little diversion. That was a really good one. So really good way to start. Let's talk. Shall we move on to some news? And the first article is from Mortgage Solutions. So here we go on to the everyday podcast stuff. And harping back to last month, Tony, I was right. I said no hike, didn't I? So the Bank of England held his base rate at 5.25%. Who knew? But I think there's a but in there, isn't there, really? It's put a little warning out there saying, oh, we're doing this now, but we might not do it next time. So come on then, let's have a look at this. I mean, it's been good. We've seen some rates dropping from the big players, but let's see your opinions, Tony. I'm going to come to you first, because I know you've got something to say on it. So
well, look, it's personally it's a good thing, because my mortgage has gone at over £1,000 in the last 14 months, so I'm really happy to not have another month of it going up a bit more, quite frankly. And that's amplified around the country with everybody that's on a tracker or coming off a fix, quite frankly. So the good news is, as a result of that decision, swap rates have come down by 40 to 50 basis points, which means that fixed rates are starting to come down. Okay, and it's always interesting now, because you've now got fixed rates below the base rate. And this is one of those questions in life, isn't it? We haven't explored that. Is it right that a mortgage rate is less than the underlying rate in the industry?
Yeah.
And it's a question, should it be? And I don't know. I think that's probably one for debate. So, but the good news is rates have, our market likes certainty, and the certainty means that rates kind of start to stay where they are. So we've seen it plateau. We've seen rates start to drop more aggressively in the high street for the mainstream customers, not so much in our markets of specialist and complex, where it's always been about the solution, not the rate. The rate has to tick a box, but it isn't the box. Mm-hmm. So we haven't seen as much downward impact on that, but it's starting now. I've started to see a number of our competitors starting to make tweaks downwards, which ultimately drives the market, and then everybody, if they want to stay relevant in that market, will follow suit. So you will see that downward pressure. But I think the key thing is we're not going back to the old days. It's not going back to the sub 2% or even the 3%. It is. Well, I can't see that in the short term. If it does go down, great, but it's not be anytime soon. And as I always say, since base rate began, the average has been 5.25%. Mm-hmm. So, funnily enough, we're exactly where the average has been since 17 whatever, when the first base rate was recorded. But certainly over the last 30 years, it's averaged 5%. So we're down to where probably we should be. So there's an impact. The impact really is affordability more than rate, because it's the affordability that determines how much you can borrow, and that's where the challenges lie on both residential and buy-to-let markets. So that's the key. So a good decision. Didn't really have a lot of choice to see anything they can do, put it up or down. They haven't got anything else, so it's a bit of a binary tool. It's either out the hat or in the hat from the rabbit. So I think that needs development over time, but it's a good thing.
Jonathan,
please.
Do you want to come in on that?
Interesting. So I think all the economic markers before it came out were that we're going to see another 0.25%. I was in a meeting with a estate agency group we work with literally the day before, and that was exactly it. We had a strong pound, and that the Bank of England base rate was going to probably increase by another 0.25%. So that was the general market sentiment. So I think it was a great deal of shock when that base rate was held. I'm not saying it's a bad thing or a good thing. I don't think either. I think we've got to see how this plays out. I mean, like Tony said, I just dive straight into the swaps rates. What's happening in the market and what does that look like? So swaps rates held, drew back a little bit. Last couple of days, they've started to bounce back. So, are we now seeing that kind of change and that's going to flip a little bit and start to rise? We haven't beaten inflation. And that was the big news, was the government declared victory on inflation. 0.1% while fuel was still going up and we're heading into winter was not a win. If we think we've seen the last of this, we're just misguided. We've really got to be very, very guarded about this, because we've got clients at the moment that are saying, well, just wait until it comes back up down a little bit lower. No, absolutely not.
You can't do that.
Apply, get something locked in. Then if it goes up, you're safeguarded. If it goes down, we look at a little switch and we see what we can do a little bit further down the line. Mm-hmm. We're still pushing that, we need to be in there 6 months early, make sure we kind of get the right advice for the client. But genuinely, I look at this and I say, this is another bubble. I think we've got another base rate rise coming later in the year to try and curb inflation, because, as I say, the heating's going on. It's been a bit chilly the last couple of weeks. I don't know about you. I've been fighting that at home. That heating was not going on. I was like,
I haven't done mine.
That thermostat was not being touched. That's it.
Yeah.
No, absolutely not. Put another layer on. But now we're getting into this point of, November's around the corner, December's around the corner, heating's going to go on. And although the energy cap's held or reduced for this month, there's talk of that energy cap going up again in January. So there's so many different factors coming into play here. We've still got the Ukraine war going on. We've still got all those things going on in the background, which multiple companies have blamed on prices rising. So I think inflation will probably jump a little bit, and it'll be another unexpected jump. But I think we haven't seen the back of this. We really haven't.
I don't know how unexpected that is when yesterday the barrel price shot up and was fluctuating so badly because of America. It was just insane yesterday. So we are going to see the fuel prices rising. And I agree with you. I think they took an opportunity to make everyone smile for a month or two. I don't think it's permanent.
It was a placebo effect, really, And it's interesting because logically you'd keep rising it because you have to, whilst it hurts the mortgage market, it stifles the desire to buy. But it's a committee, right? Yeah. There's no logic involved. It's an emotional decision by 9 people. So,
and it was a 5-4, wasn't it? It was a 5-4 decision not to raise it. Yeah.
5-4, so it could easily go the other way. So I agree with Jonathan, actually, listen to what he's saying, that I don't think we've seen the end of this.
I think the interesting thing, we say it hurts the market, but every single time in recent months, when that base rate's gone up, what's happened to rates? We've had a little bit of a shock in some months where when inflation's been high, but since inflation's been pulling back a little bit, the next thing the lenders have done is pull down their fixed rates. So yes, track of variable rate mortgages. I'm in the same boat as you, Tony. I'm sitting there waiting for this thing to drop so I can make a bit of cash back on the monthly payments. But I mean, we really truly have seen the opposite effect. When the Bank of England base rate over the last few months has gone up, swaps rates have come down. And we've seen that's what's led to the situation we're in. Now we're also dealing with the fact that the majority of lenders this year haven't lent their book as quickly as they would have. So they're still scrapping to try and get rid of this year's money.
You've got an artificial war going on. That's the key.
And that's why you're seeing that disparity between high street and non-high street. High street need to hit their lending books so they can start lending next year's money.
Yeah.
And they've probably got another 6 weeks to do that before they're into next year's tranche, if that.
Yeah. If not even that, it's probably, there's probably a couple of weeks, because it's about 12 weeks, the average turnaround, I think. Well, on a purchase, probably Remo's about 9. So, they're kind of hitting that. So you're right, it's an artificial price drop. And as you say, it's just, and again, what you've seen is we had some normality return to the market when fixed rates were challenging because variable rates were cheaper, as they should be, right? Because you're taking more of a gamble. But now fixed rates are cheaper than discounts again, which is not, fixed rates. The history of fixed rates were you paid a premium for certainty. And all that reversed until 6 months ago, where it went back, which was great. And we saw the rebirth of variable rated. And we've seen a hell of a lot, because actually for the right client, it's the right thing to do, but actually now fixed rates are lower than discounts again.
The big indicator to me will be when 2-year fixed is lower than 5-year fixed, then we're back in a normal market. That is the. I mean, we saw, for those who've been around long enough, 2007, 2008, where the base rate was, we had sub-base rate of fixed rates at that point and trackers. That market is where we're kind of heading at the moment. Not to say we'll get the same economic shock, but it's still like there are hallmarks there to be wary of, at least. Not worried about, just wary of.
Yeah, absolutely.
Well, I can tell you two have read the topics ahead, because that's the next story, isn't it? Carry on.
The last bit to mention really is there's obviously all the histrionics, and we mentioned this before about rate rises, but with the predominance of a market on fixed rate, this doesn't matter to you unless your rate is coming up. So there's a whole, and that's only 1.8 million savers out of 30 million that have a mortgage. So actually, you've got to put it into context. Most people need to be prepared for a shock if it's in the next few years, but don't panic about it. Just deal, cut your cloth accordingly to get used to that point. That's
this
the
is
key.
The coaching part that advisors just need to learn. I mean, we've had a lot of order takers over the last few years, and I think now's the time for advice. So it's gearing those clients up 6 months before the end of their deal. Let's see what deals are doing. Okay, how can we acclimatize you to that? What savings can we make? Are we really going through their bank statements and seeing where they can cut cost? Or are we just saying, that's your new payment, see you in 6 months? That's the advice part. And true advisors should really be going through those bank statements, combing through them as they should, trying to find savings for their clients in every single area. And that way they'll find the money. You can find, most of us could find a couple of £100 each month by not spending on a few extra bits. And then once they acclimatise to that new payment, it's less of a shock when it hits them.
So the next article was from Mortgage Introducer, just so the audience knows. We've kind of delved nicely into that. It's from the 21st September on the certainty versus flexibility of fixed rates and variable rates. So the point I was going to bring up, you guys have just talked about, which is down to the broker's understanding. Because we've had this, Jonathan, for your benefit, you went on the podcast before, but on the podcast before, we've discussed the fact that because of the environment we've been in, younger, newer brokers don't have the knowledge and understanding of variables and trackers, and they perhaps are not so comfortable in talking, as you were just saying, in talking to and being a good advisor on those products. So maybe some tips and advice for those younger brokers that are listening.
Don't ever discount it. Don't just head straight for the fixed rate. Find out what the client wants. Find out what the client's expectations are. In a consumer duty world they're in now, we need to tailor advice to every single individual. If you've got a client that sits there and says, look, we're not entirely sure where we're going to be in 24 months' time. Like, we think that rates might decrease and take their own sort of thoughts on it. But asking the right questions gets you the right answers. So it's really kind of, for younger brokers, it would be just understanding that client and what really makes them tick. Can they afford for a little bit more pain? And do they think there's going to be a medium-term gain there? We've got a couple of clients at the moment that, typically, historically, they would have been, your 2-year fixers, right, we want to get the cheapest deal in the market. Now they're thinking, do you know what, actually, we might move in 6-12 months. What's that look like? In 6-12 months, are we going to be in the same situation? We've talked already about maybe the Bank of England base rate in 12 months' time might be something with a 4 on it, might be something with a 3 on it. Never know. Can't tell in this market. But are we just locking people in for the sake of locking people in because it's the quick and easy deal? Or are we really giving them the advice? So just look at the whole thing. Everyone automatically goes to source with fixed rate. Click everything. Find out what they're after. I mean, we were even looking at, God, not many advisors use these. We were looking at offset mortgages for a client the other day. High amount of savings. Like, can we make something like that fit? Can we get creative and make sure that the clients are seeing the best value out of their advice?
Good advice, Tony.
Yeah, no, look, just to echo it, that it's, I know what advisors obviously have to ask the question around fixed rate certainty, and it's amazing the amount of answers to the question you get from the question you ask. You want certainty, yeah, great, fixed rate, which is just lazy. And the key thing is they always ask. I'm sure Jonathan will say the poor brokers will go, "Tell me what you think interest rates are going to do." Look, we're not economists, so how the bloody hell do we expect our customers to be economists? They haven't got a clue. Yeah. The right question is, what's the impact of a rate rise or a rate reduction on you? How would you feel about that? How can you afford that? Yeah. Because that then determines if someone says, well, I don't mind, I can afford it, then potentially the variable rate is cheaper. The challenge we have at the moment is fixeds are cheaper than variables. So because we were saying, Jay, and if you remember last year, that look, fixed rates are here, variable rates are a percentage cheaper. So actually, you've got 2 or 3 base rate rises before your parity. Mm-hmm. So if you can understand that it might go up, you're going to save money, however, before it reaches that pinnacle. So that's the tenet behind it. The challenge you've got now is that fixed rates are potentially lower. But it's then more the question of, well, what's your plan for your house? What are you planning to do? So you're not locking that client into an inappropriate deal which has got exit penalties. So it is about, Jonathan said, quality advice. And, for all non-brokers listening to this, go and find a quality advisor. There are enough Trustpilot, enough reviews where you can find the right advisors. Do that, because that will save you thousands, basically.
Yeah, you just can't beat tailored advice. You try and pick something off the shelf or second guess it yourself, you're in for hiding. You really are. It's the same argument with 2 and 5 year fixed at the moment. 5 year fixed are cheaper, but why? Mm-hmm. Are they thinking they're going to lose money in the next 3 or 4 years? What's the advice for the client? Are they looking for stability for the medium term? What you need to get under the skin of every single client, their own what makes them tick. That's my advice.
Yeah, spot on.
Well, that was a really good piece. Thank you, guys. Really, really interesting. Just if anyone just want an economics and market lesson, join us for November's podcast, where we will be joined by Ray Bolger. And last time he came on, I walked away with my head. I had a headache. I learned so much in an hour. I walked off the headache. So he's coming up in November. So keep an eye out. That was our most successful podcast since we've been running this, wasn't it, Tone? Last year, and this year anniversary. So we're bringing him back for an economics and markets lesson. So I'll be getting my learning head on. Okay, so let's move on. This is something we talk about a lot, Tone, so we're going to go on to the green agenda slightly here, I think. In the Rishi Sunak has scrapped EPC regulations for landlords. Now, we talk about landlords and buy-to-let generally. We talk about these regulations. We've talked about this new bill in detail. If you want to listen back to a couple of months ago, we had a brilliant legal expert on talking about this. But this comes at a time where the government seems to be turning and backtracking. So I just wanted to open this as a conversation as to what it means for an industry that was already struggling with a green agenda to then have a government that just seems to be backtracking, turning. Now, I can get quite opinionated, so I'm going to try not. So I'm going to pass over to you guys first. So, Tony, come on. There's positive and negative to this, isn't there? And I do see both sides, even if I take one side on it. I do see both sides of it. So what are your opinions, your thoughts?
Yeah, look, it takes one sort of Damocles off a raft of portfolio landlords and buy-to-let landlords that you haven't got to do this, okay? And it's not a surprise. I think we all knew that it would be pushed out from the original date. But the concern is, I think, as you've raised, is actually, look, as I say about green, right? I always have. We're not at the point where we're doing it altruistically yet. It's all about what's in it for me, right? And that's life. No one does anything till they understand or have to do something. So we're going to get to a point again now where you don't have to do anything. So it's just going to stop in that. In that landlord market, private rented sector market, it's the ones who want to do it will do it, but most won't if they don't have to, because there's nothing holding them to it.
And
so
it's
I
costly.
think that's
People don't want to spend the money, do they?
Well, it is. Look, as the quote says, we know a lot of landlords have been selling property. You know, Jay, we were on the same panel debate with Roger Morris telling us that if a house is worth 160k or less, it was not worth retrofitting. It made no commercial sense to do it.
Yep.
So offload it from your portfolio, which we have, we've seen a bit of, or we've seen some offloading it and some grabbing those cheap bargains to grow their portfolio. So I think it's a shot in the arm for a market and landlords that have been battered over recent years with tax cuts and green things and everything. It's probably a retrograde in terms of how we attack green as a society, or certainly as a mortgage industry. And yeah, it's just, I suppose, overall disappointing. But until we really all agree why we want to be green, this is going to happen. And I think we're still a long way from achieving that agenda. Green at the moment for everybody in our world, if I'm honest, as you know, I say this, is about saving money, not saving the planet.
Yeah.
It's about getting food on the table and heating the house in the cheapest way possible, not ensuring that, the pangolin, as I saw yesterday, is going to go extinct very soon. We're not worried about that yet. I know that's a random example from somewhere in Asia, but it was what came to me at this point.
And I thought you were going to go with turtle doves. That does actually. You went somewhere in the depths of somewhere else.
Animals that are on the edge of extinction, but that kind of makes the point. Yeah.
Before I flip it, Jonathan, I'm going to let you cover that because I'm going to flip it the other side in a second. But yeah, just come from your perspective, and actually what your customers are asking for.
So there's two sides to this, right? So there's the landlord side, and then there's the tenant side. Okay, I think there was an article earlier in the year that I read that something like 59% of all the stock in the residential letting market was below C grade. Right, that's huge. That means that there's like a vast majority of people that are renting houses at the moment that are having to spend more on their heating. So that's what it comes back to. I mean, I appreciate why. Like, I'm a landlord. I don't want to be hammered. I don't want to be taxed too much. I don't want to have to really do these things. But on the flip side, I want warm homes for the people that live in them. And I want that medium-term security for the property. So it's costly. I think the issue here needs to be tackled at the EPC scheme is just not fit for purpose. It isn't. I think, there needs to be a real rethink on that and how that kind of works. To try and benchmark, houses alongside fridges just doesn't seem to make a lot of sense to me when you're looking at the energy efficiency of something.
Nobody gets it. Do you feel like nobody gets EPC? I just don't think anyone gets it really. I mean, there's not in the industry.
The first time it's irrelevant. This is the first time when the government announced that they needed every property to be A to C by 2035, whatever it was. That was the first time I've had landlords look at their EPC certificates and go, what's it mean? And there was no guidance or support to say, well, to get there, these are the things you need to do. And if the government were really interested in the green agenda, at that point, they would have started doing grants for landlords and fixing the issue and making these homes warmer. But as you rightly say, who's going to put their hand in their pocket, spend 15 grand retrofitting something that they can get an extra 50 or 60 quid a month for? It's not actually going to meet. There's no real link between rent achieved and warm home. There's just not.
No,
and if anything, you create this two-tier market where you get people exiting and selling off their lower value stock, as we've seen, and then not reinvesting. And what people forget is that landlords on the whole, I know there's some unscrupulous ones out there, but landlords on the whole are a service provider, because without landlords, we'd be looking at social housing again. And local and the government don't want to build more social housing. So like, we need to get behind our landlords so they can get behind their tenants. And this change was probably, you could see it from a mile off. If they're going to cut anything, it would be green initiatives, right? Because they can close a department down pretty quickly, and put that down as a tax saving or saving whatever they need to do. But I think the metrics for this need to change, and there's been a few things now that have come across in the green agenda that have just been like us pulling back on a global stage, whatever it looks like. But this is really hurting tenants and how much they're paying. As I say, gas and electricity companies are making record profits, right? So, I mean, is there a link there? I don't know, but I'm not gonna sort of play the fantasy.
Don't get me started on politics. But I think you're absolutely right. We're in a cost of living crisis. Yes, the price cap's gone down a little bit on energy prices, so those tenants are perhaps getting a little bit of relief. But just
during
having
summer,
watched or listened to exactly that. Mine Lewis was on this morning, starting a new campaign with loads of organisations behind him, saying you need to start feeding some of these, the lower end of the scale, feeding them some money back into their bank accounts because they're not going to be able to survive this winter. So you're absolutely right. These changes that landlords can make will make a huge difference to the renters. And I think that is forgotten in this part. But again, that's typical of a kind of government approach of house, the homeowner, the renters are almost forgotten, hence why we don't have any social housing anymore. But let's not go on about that. But so I think there is a direct link there. But I think the pullback on green issues, Tony, I don't know if you agree with me, but the pullback on this, it seems to split, but it seems to be just focused on the fact that they won a London borough based on ULEZ, which is completely irrelevant because that is actually directly impacting the people from their bank accounts. Some of the measures that we were doing, like the electric cars, affects absolutely nobody unless you're buying a brand new car. They're not saying you can't drive your petrol cars anymore. So there's all these changes. And I just think, for an industry that was trying to drive the green finance agenda, we're going to suffer twice as badly, Tone, surely.
Yeah, no, it's the one thing the industry really needs to work together on to try and solve. We all have a variety of, to be honest, greenwashing products out there that do stuff, but we need to incentivize. And that's why I applaud the Nationwide with what they did, because that's the first kind of thing that incentivized people to improve your home, with the up to 10K interest-free further advance. Amazing. Yep. All right. Great stunt because it's for a limited number of people and it's well costed. So, but it's brilliant that I love that. And, we're actually looking at things like that as a business. Green is, we're not saying we're green, although we do have a green product which has been out there for a number of years and does help those with a non-C to A rated property, and we reward those by making an improvement. But we need to do a lot more. We want to be, as a business, green, not just have green mortgages. So but unfortunately that does take time. But collectively, as we've seen from all the MIMHC getting together, collectively starting to focus on issues as an industry, if we do that, then there's economies of scale if we all get involved. Sometimes issues are bigger than competition, in my view, and we all need to do something together. We're all just, everybody's, the problem with our industry, we all wait there to see who's going to do what before anybody else does it. And it's the biggest game of poker go in the mortgage industry, having been in it for so long. But sometimes you've just got to go beyond that and break those boundaries. And I think this is one of them. But it's always to that point of, unless we really start understanding why we want to be green and take the financial cost out of it, and the fact that, do we want a planet for our kids and our grandkids? We're never going to get the change needed, in my view. And I sound like Greta Thunberg here, but she's far more eloquent. But that's the reality of it.
And it's true. Our property is rubbish. We have the worst standard of property when it comes to energy efficiency, and I just see this as a huge step back, because actually, you know, the landlord's showing good practice and doing this work. And as you said, Jonathan, an incentive of some kind of grant for landlords would have been a really good way to start. So other homeowners would look and go, I want to join this force, because I understand that our property is a big issue for us. And if we're going to get to 2050 and be net zero, bearing in mind that is net zero, we need the housing stock to be improved. And I just see this now as a backwards.
Yeah. How do we future-proof our stock? And in any industry, like, you know, you look at sort of, I don't know, care homes, for instance, right? So, you know, how can they make their businesses more energy efficient? Well, they can put solars on the top, put better insulation, and make them warm for residents, right? So why is that care given to those sectors, but not to our rental sector? And that's the thing. And there are grants for that stuff. So they're commercial grants. Yeah. So I think the government have stepped back on that, and for their own reasons, right? Okay, we're not, again, this is way above our pay grade, but when we're looking at kind of how the true impact on this, and you've mentioned about the choice between heating and eating, and we've got sort of fairly middle class families in good rental properties, rents having to go up because, you know, mortgage interest rates have gone up. There's more pressure, stress testing to try and meet those stress tests. Rents have to go up. As a result, that squeezes the pocket in other ways, and we haven't got that visibility with tenants that we do with home buyers and sellers, of actually being able to coach them through what that means and how to cope with those things. And so it is down to landlords and the industry as a whole, really, to wrap our arm around our tenants and make sure they're well looked after. But yeah, I agree with Tony there. I think there's a degree of greenwashing there. But this kind of negates that now. So you will see which lenders are really getting behind this issue now. Now these A to C band ratings have been, this whole issue's been disbanded. Are we going to see lenders with a resurgence, like a Nationwide, turn around and go, tell you what, even though it's not on the agenda, to look after your tenants, have a 10K interest-free product, a further advance to make that home warmer for them. That would be the real asset.
So lenders doing what the car market's done when they've retracted. They've said, actually, we're sticking with 2035 because actually it's better for, you know, the environment. And actually, you know, this pullback is, again, it's similar with the motor industry. It's like changing the goalposts and moving them around. It's not good for business. People have got long-term plans and things in place, and it's just it's ruining business.
Absolutely. So I think, just back to your point on the car industry, that you might sound like they're being really good and saying, no, we're sticking to our agenda. Actually, no, they've done all the organisational change to hit that, and it'll cost them too much to back out of it.
Absolutely.
So they're not that nice. Let's not deny that.
No. But this is profit,
my personal opinion, obviously. One of the things I would say, though, about our housing stock to others, and you're right, we have got an ageing housing stock, and one of the problems is we don't build enough of our own houses. We rely on somebody else to build a house, and therefore that determines our green credentials. Unlike the rest of the world that actually has a self-build or custom-build approach to up to 70% of their housing stock, as opposed to our 15%. So actually, if we start building more of our own houses, then we can make this change quicker. And we need to just, you know, it's a real passion for mine personally, and also the society around educating, particularly brokers, to the awareness of self-build and custom build as an opportunity for their clients, who a lot of people shy away from this market thinking it's for a certain, you know, B to A sociographic market. You got to have loads of cash to do this. It's not. And it's about how we do a lot of education on how to help people understand the house building reform that's going around through local authorities and the opportunities that there are to build your own homes. That's one way to tackle this, to make it more accessible. All right, it's still only a small part, but it all helps.
I think also that's available to first-time buyers. I think that was the bit that I've learned the most over the last couple of years, is that I wouldn't assume as a first-time buyer, if I was a late 20s, early 30s professional, that I could actually have that much influence over my house. And actually, those people are the Gen Zers that have had this, the environment and sustainability drilled into their heads and would prefer a house like that. So actually, you have got a chance as a first-time buyer to build your first home. And the custom build was a really good example, Tony. That I can't remember the name of that Channel 4 program. I always push it because I love it. The street, I can't remember what it's called now.
The one in Graveney.
Yeah, that's the one. Yeah, I always thought that was a really interesting thing to look at, just to get your sort of education up. It was just something interesting and interesting to see, and kind of open your mind to something different. I think it's really key. I knew we'd talk a lot on that. So as we come towards the end, we've got a little bit of time left, so we'll move on to our final topic. Don't know what you want to say about this, to be honest with you, but it's one for all of us. So there's less than 1 million outstanding. Is interest only on its way out? Asked the FT advisor. Tony, coming to you. Oh, shaking head.
No, if I'm honest, we've seen a resurgence in interest only in the last year. There's more and more inquiries because it becomes a cost-effective route for those who have a sensible repayment strategy. It's a perfectly viable opportunity. I'm on interest only. I have been for 15 years. I've got an offset mortgage. So, when I took it out, First Direct did their job. They checked how am I going to repay this. I explained it. They were comfortable, and we've kept up to that. It's a perfectly acceptable way of borrowing money, but the advisor has to be really tight with them, saying, guys, you have to pay this back and be sensible. Otherwise, you're going to end up with a massive bill at the end of it, which is, we're seeing a lot of poor advice from the late 90s, early noughties now coming to fruition, where people are going, I've got no way to pay this. I don't want to sell my house. You told me that would be a great way to do it. I don't want to do that. Who does? So as long as it's advised responsibly and understood by the borrower, this is a huge thing. We do a lot of it, and actually we were one of the only lenders that's never really pulled out of interest only, even during the credit crunch, because we saw the value of it. As long as we could make sure that they could afford to, they had something in place to pay us back. That's the key.
Yeah. So I think there's a two-tier market here, isn't there? There's the market, as you were just saying, Tony, that are coming towards the end of their interest-only mortgage and are like, crikey, how do I repay this? And these are people who are reaching a retirement. We're hoping to sit on a nest egg, but the property hasn't increased in value as much as they previously hoped. They'd be thinking they'd be downsizing to an apartment with plenty of cash to be able to clear that interest-only, and off we go. Yeah. So it's seen the rise in, obviously, people leaning towards equity release and of course, retirement interest-only mortgages. So kicking the can down the street a little bit further, but a good product for the right people, of course. So it's those new entrants into the market, as you rightly say, who are seeking that blend of affordability and lower monthly repayments, but with a sensible strategy. Talking of blends, I think the blend of that mix of interest only plus repayment will be a good option for a number. So making sure you've got a plausible exit at a certain level, which will allow you to go on and buy something else. But yeah, I think we haven't seen the end of it at all. No, I think that's to even suggest that, I think, is short-sighted. This is a great tool for those people who want to buy something that they have that aspirational purchase as well, something a bit bigger, a bit more space that's going to see them good in the future. So I think we'll see more lenders leaning towards a blend of interest only and repayment. That's my thing.
Yeah, I think that's a sensible thing. I think what we have seen the end of is the downsizing as a repayment strategy. Yeah, because that's fundamentally proven not to have worked for thousands of borrowers who are now facing big issues. So I think that's gone. But I agree that the part and part approach is a great way forward for those to as we say, reduce that cost, even in the short term, with a with a recognition that they have to do something about it on a pretty much straight away basis if they want to reduce that
Absolutely. Shock. There'll be a lot of criteria, I think, coming around, sort of minimum exit price, minimum exit value, all those kind of things. I mean, there's a few good lenders out there that have already got tapped into that, looking at what the local markets are doing and saying, how much could you buy another property for in X, Y, and Z location? So you might see some locational nuances there, which will be quite interesting. But yeah, on the whole,
Yeah, we've just changed our policy to do that. We had a blanket 250 equity, but we have now reduced that down to 150, geographically kind of split. So that if it makes sense in your area, we'll consider it, definitely.
It's the same thing I didn't know. Buy-to-let mortgages often interest only? Tony?
I think the question is, are they often a repayment?
Pretty much. Are they often not interest only? Yeah. No, they always are. Look, it's landlords hope to get revenue income and then cash in on the capital when they want to get rid of that property. That's
it's
how
changed,
it works.
Doesn't it? I think historically, pre 2007, 2008, it was seen as you write down the value of the property over time, and then eventually you're left with a big old cash slug. Now it's an income driver with capital appreciation, and that's the way it's been now for the last 15 years, really. I can't see that changing a great deal.
Okay, great conversation. That's bringing us towards the end. So just before I go into that, SFI Live's on a pause at the moment, Tony. We'll be back in due course. There's some discussions having on that. So we will give you updated on that. So please do follow Saffron for Intermediaries on LinkedIn to keep up to date with the webinar schedule and to keep up to date with when these podcasts are released as well, although they are available on the 1st of every month. Jonathan, thank you so much for joining us. I hope you'll come back.
Yeah, been a pleasure.
Be great to have you. It's been a really good conversation today.
It's been brilliant to have you on.
Thanks for inviting me. Appreciate it.
Absolute pleasure. And I just wanted to say sorry that we couldn't get Phil on. Phil was joining us, but he had a personal issue. So, Phil, we look forward to seeing you in November. Just a reminder, if you are listening to this podcast on your favourite podcast channel, please give us a 5-star rating, leave a comment, because it does help other people to find us, which is really useful for us. And do look on your channel and look back at some of our previous episodes, some of the things we've talked about. And we have got specials on everything from, and in fact, we had a bit of a buy-to-let landlord special last time, so do have a listen to that if some of these issues have raised with us. And Jonathan, we will call you back to find some updates on what's going on with mental health in our sector as well.
Thank you.
Something we will definitely come back in a few months' time, and we'll revisit that issue maybe when Saffron's signatory has been put on the list, which is really good to see. So that's it. We're back again on the 1st of November, and as I said, our special guest is Ray Bolger, and we are going to get an education on markets and on the markets and economics in general. He's really, really knowledgeable. If you want to hear his previous one, look back. It was October 2022. But that's it from us. A big thank you to everyone. Thanks, Tone. Sorry, I should say sorry. Thanks to Tony. Really should I?
That's all right. It's fine.
It's here, everyone.
We're friends, mate. We've known each other.
Yeah, no, so thank you. Thank you very much for joining us. So please give us a 5-star rating, and we'll see you again in November. Sorry. Goodbye.